just know there are lots of people behind the camera. So here's what to expect. I'm starting with this intro. Tim's going to talk about the topic, demystifying the Federal Reserve. And then we're going to do Q&A. There'll probably be less time than usual for Q&A. We're actually going to do a format where all of our priority campaigns, organizers from all the campaigns in Metro DC DSA, will have a question about how the Federal Reserve might affect their organizing. And then we'll do audience Q&A. And perhaps the most important part, if you are here, we're going out afterward. We're going to try the Marx Cafe, very appropriate. Hades if it's busy. But if you're listening and you're near Mount Pleasant Library, if you're here, we are going to try to go out afterward and would appreciate your help putting the chairs back into the right place. But essentially, we are, you might go into your slide. This point. It's not, oh, I'm not, oh no. Anyway, we're Metro DC DSA. We're an all-volunteer run organization fighting for Socialist DC. The priority campaigns that you see are up on the screen. They're defunding MPD, giving the money to programs that care for people. It is labor, fighting for working people. It is Stomp Out Slumlords, which is anti-eviction canvassing and building organizing. It's rent control and social housing. And it's We Power DC, which is about municipal electricity and fighting climate and lowering rates through there. And so I'm with the Political Education Working Group. And we'll cover the details at the end, but we're running reading groups. There's 7 this summer. And we have lots of great programming. If you can go to the next slide. And we have great upcoming events. We have the speaker of Villains of Silicon Valley walking tour in the house, Malcolm. And we have upcoming night schools and other events. I'll cover this in detail at the end. And if you're online, we will share the links with you. And if you're in person, there will be material at the table along with that. And so let me be presumptuous by telling you will not take away from today. You will not conclude that the Fed is too large. You will not think it is fatalistic. You will not give up because there's a lot of organizing going on. If you're not connected yet, we'd love for you to be connected. If you are organizing, I hope you get something from this talk because the Fed affects a lot. And so finally, I'm here to introduce Tim Barker. And so Tim is not only one of the preeminent scholars on the Fed and of post-war US history, he's also topical. He wrote a dissertation on the political economy of American military spending between World War II and the end of the Cold War. And much of his public writing has been on monetary policy. So his article, Other People's Blood, is what inspired me to ask him to attend today. It's about 1979 and the Volcker shock and made deindustrialization and the Reagan Revolution seem not inevitable. And so his writing was very important to me. His writing on the EndNotes Collective helped shape my worldview. And there's no one better today to talk about the Federal Reserve. And so I'm going to sit down and give Tim a round of applause for Tim Barker.
Thanks so much, Taylor. That was really a kind and in some ways extravagant introduction, but I'll take it. And thanks also, there's really a group of many people here at Metro DC DSA who work to make this hybrid event possible. So a big thanks to everyone who had a hand in that. I'm going to talk about the Federal Reserve, demystifying the Fed, and I'm opening us with this image from a movie. Anyone ever here see the movie Mad Money from 2008? This was described by the New York Times then as a breezy, amoral heist comedy starring Queen Latifah, Diane Keaton, and Katie Holmes. The movie is about a janitor at one of the local branches of the Federal Reserve, a single mother and a resident of a trailer park who make an interracial working class coalition to steal money from the Federal Reserve, where the main character works. So I put this up as a sort of image of how the Fed is kind of omnipresent in our culture. Everyone knows it exists, it's a thing, but it also is kind of poorly understood. And if you watch this movie, you would come away without really having much of an understanding of what actually happens at the Federal Reserve, in the Federal Reserve System, except that there's money involved, which is, not untrue, but there's more to it than that. And I want to say just another word about the demystifying part of the title. Taylor was very kind in his introduction to refer to me as a scholar of the Fed, and I am that now, but I'm not a central banker. I'm not even an economist. I'm a historian, and I came to these questions, really kind of from the outside, and feeling what I think a lot of people feel, that it would be hard to understand, that it's very opaque, technical. And I think that a lot of things are less complicated than they appear, and that they can be understood by most people. And I found that my position as a kind of outsider or trespasser has, helped me talk about it to a wide group of people. But it's amazing to see such a big audience here. There may be people here who know more about some aspects of this than I do, and it would be great to hear from them otherwise. But I really will be trying to talk, assuming very little knowledge, right, and trying to build up from that into a basic understanding of what's going on from the Federal Reserve from the perspective of a socialist today. And so I was going to start with really just a summary of the two big points I want to try to make today, and you guys can decide whether I've done that at the end. The first point is probably not that controversial, but it's worth saying to begin with that the Fed is maybe the most powerful single institution in US and global capitalism. Decisions it makes have the power to influence economic conditions, and if I had finished writing that first point, I would say affect everyone's life at some point, right? The decisions they make affect the rhythm, pace, direction of economic activity in general, both in the United States and around the world. And here you have a somewhat hyperbolic, but I think not completely inaccurate quote from the New York Times Fed reporter, Jenna Smalek, who says that the Fed, especially in its most recent guise under Chairman Jerome Powell, is not just a powerful force in markets and society, it was limitless, which is the title of her recent, somewhat awestruck book about the Federal Reserve since 2020. And then the second point I want to make, which is, maybe the more controversial one, but I don't think it's especially difficult to substantiate, is that this immensely powerful institution is not only undemocratic, it's also ultimately, in a complicated way, with many mediations involved, ultimately a class institution. It's part of the capitalist state in a capitalist social formation. And as the little epigraph here, I have a quote from the much maligned Fed chair in the 70s, Arthur Burns, who said this during one of the private meetings of the FOMC, which makes monetary policy. He says, therefore, the distribution of income, something we don't like to talk about, is it a matter to watch closely. And the fact that they have to watch it closely, but they don't like talking about it, I think comes as close as anything to summing up what the Fed means for socialists and really for everyone else. I'm going to start by just talking about what is a central bank, right? So the Federal Reserve System is the central bank of the United States of America, but other countries have central banks. So we can talk about central banking in kind of a more general sense. And I think the easiest way to think about what a central bank is and what it does is a central bank is a bank for other banks, right? So think about the things that you would go to a commercial bank, branch for. You go because you want credit of some kind, right? To buy something that you don't currently have money for. You go because you want some kind of extension of liquidity in excess of what you currently have or can hope to have. And the bank in turn will extend that liquidity to you at various costs, under various restrictions, for various reasons. Some of those reasons will be written into the law, right? There are laws about lending. Some of those reasons will be purely customary, right? Or based on their, sense of view, based on vibes. And all of those things, that we see in a commercial bank apply to the Federal Reserve, but the people in the position of regular depositors and customers are other bankers. So when a bank needs to borrow money to meet its positions at the end of a business day, they do that from the Federal Reserve, right? They get a sort of overdraft from the Federal Reserve. When they need to borrow money, they do that from the Federal Reserve. When the Federal Reserve wants them to have less liquidity, less power to extend money to other parts of the economy, the Federal Reserve can take that away. So the Federal Reserve is a kind of bank for other banks. And by making various kinds of decisions that affect how much credit and money the other banks will have and will be able to create for businesses, for households, the Federal Reserve, through the banking system, can affect the availability of money and credit in the entire economy. And through that affect, at least to some extent, every kind of economic activity, right? And all kinds of spending and saving and investment decisions. So now we'll get a little more specific about Central Bank of the United States, which is a kind of strange system, which is a public-private hybrid. The Federal Reserve System is created by an act of Congress, the Federal Reserve Act, but only parts of it are actually part of the federal government. The Federal Reserve Board of Governors is part of the federal government, and its members are presidential appointees. But the 12 Federal Reserve banks, which we'll see in a minute, are regionally dispersed. Those are actually privately owned institutions. They're a little different in some details from other banks, but in most ways, they're really like other private businesses. And I quote here from, this is a description you can find on the website of the Federal Reserve itself. It's not a left-wing interpretation. The Fed themselves say that the reserve banks operate like other businesses. They have a board of directors who come from like the local business community. They have their own sort of like, shareholders and stuff. You don't make a profit from it, but it is technically privately owned by people from the economic region it represents. And their actions are subject to the oversight, ultimately, of the US government, but they're not themselves part of it. And a way of making this concrete is that, for instance, employees of the reserve banks are not federal employees, right? They're employees of the reserve banks themselves. And so, as I mentioned a second ago, the reserve banks, right, the private part of the public-private hybrid are distributed regionally. And the interesting thing about this map is it tells you a lot about what the country was like and how economic activity and power was dispersed in the country in 1913, which is when the Federal Reserve Act was passed and the system was created. You see, for instance, there are 2 banks in Missouri, right? And 1 bank for the entire, most of the Mountain West and the entire Pacific coast, right? And that tells you something about where economic activity was in 1913 and where political power was. If they drew this map differently, they drew it today, they would draw it differently. But this map is a kind of a living symbol or fossil of the fact that it was a political act that created the Fed, not a sort of natural act, not one based on technical economics, and certainly not one being updated constantly, but one that bears the imprint of all these past things that have happened in our history. And I have a link here at the bottom to a page with a lot of resources on the sort of basic structure of the Fed. So more of the stuff I've been saying at the beginning. These resources include a series of comic books, which you can view in PDF, or you can actually order free copies of them. They'll send you a box of copies of them. But I think they're actually, we could do ideology critique of them, but they're useful resources, I think, for this demystifying purpose. They're designed for school children. Some of them have the conceit that there are Martians trying to understand the Federal Reserve System, so they really have to explain it as if they would to extraterrestrial life forms. They're available in English and Spanish. And so I think that for these kind of basic points, people should, without any embarrassment, make use of these comic books. You could order them in Spanish, order them for your chapter. If you're a teacher, you can order them for the classroom, and you can critique and say things about them, but they're useful and they are available for free. So I'll just put that out there. Now I want to talk a little bit more in detail about what the Fed does. So I said, as a general point, the Fed is like a bank for other banks, and that by banking for these banks, it can control all kinds of things about the economy sort of indirectly. And they do this in a couple of main ways. Monetary policy is what we call the set of things they do that affect the amount of money and credit in the economy. And they have a variety of ways of doing this, but it's not that misleading to think of them with monetary policy as basically having a throttle that they can choose to aim in one direction or another. They decide, do we sort of want on balance to promote the expansion of the supply of money and credit and economic activity, or do we want to kind of pull back on that, right? And everything they're doing is sort of moving in one direction or the other, or holding steady, right? They recently had a meeting this week where they decided to pause on further increases in the interest rate. And so the pause is an example of them deciding to hold steady. We don't want to contract more, but we also don't want to ease. And so the whole range of things they do that go under the heading of monetary policy can generally be described as either easing or tightening the supply of money and credit. And you'll ease if you want to promote more activity, right? More spending, more lending, more investment, more employment, more growth of output. And you'll contract, right? You'll want to take it out of the system if you want to do the opposite. You want people to stop lending, stop spending, stop hiring, maybe start firing people. So there's kind of a throttle, right? And there's many technical points to how they do this, but there are really just a couple big ones. One is interest rate policy, right? As a bank of sorts, the central bank can set an interest rate, and that's the interest rate the banks in the interbank market will pay. And that can act as a sort of baseline where that doesn't directly affect what a mortgage interest rate will be, or a rate on a car loan or a student loan, but it will be a sort of benchmark. Whatever you're paying for a mortgage won't be lower than that policy rate. It'll often be much, much, much higher, right? Because the commercial bank is making money on the markup between this rate and what they're charging you. But it does set a kind of floor, and then you can imagine a kind of cascade effect where everything else will move in step with this, even if it's, when interest rates are zero, right? People talk about zero interest rates. That means that the policy rate is zero or near zero. As everyone knows who has a credit card, it never means that the credit card interest rate is zero. That's still 19% or something. But if the policy rate went to 10, the credit card rate might go to 30, right? So that's sort of the way it works. And the banks are making money on that pass through and the markup. And you'll notice, if you have like a commercial bank savings account, even as the Federal Reserve has been tightening money pretty rapidly, not much of that is passed through, right? So in some ways, like, they not only make money on charging people more, for a mortgage loan or a car loan than banks pay other banks for money. They also make money on not passing through interest rates to consumers, right? And if you're a sophisticated consumer, you can get a high yield account, you can do various things, you can buy a CD. But for lots of people who aren't doing that, the banks can also make money by not really passing on this benefit they're getting in other streams of interest payment, right? So there's all kinds of ways in which the public-private thing really matters, because in between what the Fed does and what any consumer or household is experiencing is a layer of profit-making private banks, right? Completely private banks can decide what they do with the conditions created by the Fed. So the Fed is controlling what banks do within very wide limits, but there's a lot of scope left to banks to really just pursue profits, which is what they do. Because banks are pursuing profits all the time, often recklessly, the Fed also does a lot of crisis management, right? And this is what, in moments like 2008 or 2020, the Fed will sometimes come into the headlines. And this is when you hear a lot of that rhetoric of having this kind of limitless magical power, because it is the case that the Fed can extend credit in an emergency to a very wide range of institutions in the economy, and really, in certain ways, without limit. There are certain political constraints, but in a real sense, there's no limit to the amount of money they can create and then put somewhere else, right? So at moments when economic activity is contracting, either because there's a kind of crisis that's internal to the economy, like in 2008, or something like the pandemic in 2020, no matter what the cause of it is, it can lead to a scramble for liquidity in the private economy. And the Fed, to the degree that they decide it's politically viable and desirable from their standpoint, the Fed can provide that liquidity and try to head off sort of cumulative crisis, which would lead to the nightmare situation, which is something like 1929, right? In 1929, you had a sort of a panic, a financial panic, which then turned into a real sector depression that lasted a decade. And that's the thing that central bankers really don't want to happen on the downside. And so they do a lot of things in crisis. These are, colloquially often referred to bailouts, but there's a set of things they do to manage crises. Another thing they do that they do a much less satisfactory job of is supervising and regulating the banking system. So under law, they have a vast array of powers, both to regulate, which means to make the rules for the financial system, and then to supervise, which means to actually surveil and oversee whether banks are doing a good job of following the rules that have been made. In practice, as we saw kind of in detail during the collapse of the Silicon Valley Bank, the Fed pursues the supervision and regulation part of its job with much, much less gusto than they do the bailout side of the job and the fighting inflation side of the job, right? They don't like doing this. And part of the reason they're not good at doing this is because of that structure we talked about before, where they're in a way sort of answerable to and under pressure from these regional reserve banks, which reflect much more directly, the sort of interests of those banks. So the San Francisco Fed, which is, not just a spokesman for, but in some ways, literally the property of big banks and businesses on the West Coast, was understandably not applying specifically, tough lens to a bank like the Silicon Valley Bank. But they do have these powers, and in theory, they could use them more. And then another part of the job, which is important, but sort of more below the surface, is what they call maintaining the payments and settlement system, right? So every day, all kinds of payments are made electronically when checks are written, right? And the Fed provides the kind of the plumbing or the railroad tracks for a lot of those things. So high-speed transfers between different banks, right? Clearing between one big bank and another bank. Even things that people in this room, might have done. You could see that the money transfer sometimes will show up on your bank account having gone through, FedWire. So the Fed has this sort of way of providing the bedrock of the payment system and thinking about ways to make sure that the payment system doesn't break down and to make it more efficient. And that's a long-standing part of its job. Back in 1913, when the banks were founded, they had a special set of like telegraph wires that did this, right? And that's the most literal way of thinking about it, but that still exists there. And there's a lot of talk today about the possibility of a central bank digital currency, right? If they did that, you could see that falling under this heading of something they're doing to facilitate the soundness and the frictionlessness of the payment system. Now, I'm a historian, and I also think it's just illuminating when we're asking this question of what should socialists know about the Federal Reserve, what are the politics of Federal Reserve policy, right? Studying history is just a way to get directly at those politics. And when you study the history of the Federal Reserve and the origin, it's very clear that it's not just a technical question. It's a political consultation of social forces, which, if I had done a better job matching this to the slide, is what the rest of the slide would say. A political condensation of social forces, right? The Fed is a political institution. It follows political logics, right? To a certain extent, you can think about it as following its own bureaucratic logic. It's a culture, it has its own rules. But the reason it exists and the form that it exists in is a sort of snapshot of social forces that were in conflict and sometimes in cooperation in 1913, which is when the Federal Reserve was founded. And I have here pictures of, I think, the two most important social forces in play in the creation of the Federal Reserve back in 1913. One is populism, right? Not populism as a sort of generic term that you might apply to everyone from Donald Trump to the recently departed Silvio Berlusconi, but populism in a sort of capital P sense, right? There was a political party called the People's Party that grew out of organizations called the Farmers Alliances. And this was an organization involving millions and millions of people, farmers, but also workers and sympathetic intellectuals and all kinds of people, labor unions. And their major demands were monetary. So they're a political mass movement, social mass movement that was very focused on the money question. And they particularly wanted there to be more money available, both in general, because they were fighting against a trend of deflation, which is really bad if you're a farmer selling crops and the prices fall every year. That's like a bad thing. As interest rates go up, you owe money from the loan you took out to buy your farm equipment, but every year prices are falling, so your cotton crop is worth less and less. They saw an artificial constriction of the supply of money and credit as the reason for their troubles, and they thought they needed to remake the state in order to solve those problems. But they weren't just interested in the quantity of money, they were also interested sort of qualitatively in what kinds of credit the federal government would provide, right? They didn't just want short-term commercial credit, they wanted longer-term agricultural loans, and they even wanted the federal government to enforce a kind of credit system in which you could use crops as collateral, right? So that was kind of, in a way, the most radical idea they had was that the same way that a bank could take a banknote that they had issued and take it to a central bank and get money in exchange for it, they thought you should be able to do that with commodities too. So they had a pretty radical idea about how to remake the state in order to solve these problems that they faced as a result of their position within late 19th century capitalism. The other half of the equation here, we see a picture of Wall Street, right, of the of this iconic stretch of the financial district of New York City in 1907, which was the last major financial panic before the creation of the Federal Reserve. And in the late 19th century, through this time in 1907, there were just every couple of years fairly serious financial panics in which a lot of people would lose a lot of money, and there often would lead to downturns in the real economy, right? So someone would find out that a railroad stock, was overvalued, or there would be an Indian war, so-called, out in the West, which would lead people to think maybe this, branch going through Lakota territory isn't such a good investment. This news will get out, people will get panicked, people all over the world will get panicked, and there'll be this cascading effect of financial panic that ends up hurting a lot of people. It hurts, poor and working people the most, but it also hurts a lot of bankers themselves. And 1907 is the last time they kind of try to handle it themselves, right? There's a big panic and it looks like it's going to be the big one. And what happens kind of famously is that JP Morgan, right, the most powerful private banker in the country, gets a bunch of other bankers in a room and gets them to work out a way to collectively stop the system from going totally under. But it's such a kind of hair-raising experience that they're like, we can never do that again. We need to, again, they, like the farmers, decide that they can only solve their problems by capturing part of the state, right? And so from both the farmers and from Wall Street, there are these ideas that the United States needs to have a central bank, because it's kind of unusual that it didn't have one until 1913, right? The way I described it at the beginning, these are fairly basic things that a central bank does, and it's kind of wild in a way that the US didn't have one The result of it not having one was that US central banking was essentially often done in London, right? At a time when England is still kind of at the head of the international financial order. And that worked sometimes, but it really ended up not working well enough for important enough parts of American society that the US had to get a central bank. And so I have on this slide a little bit of summary of things I talked about a minute ago, right? Farmers and workers are facing the problem of deflation, of not enough money, which means that their prices are falling. It means that there's unemployment. There's a regional inequality, right? Because the way that the money supply is organized at this time means that the power over money is concentrated in the Northeast, which means that there's a shortage, a really extreme shortage of credit in many parts of the country, like the South and the West. And then there are problems for capitalists too, right? That I talked about, most importantly, financial instability. Also this question of international power. There's a limit to how much power the US can have in the international system if all the decisions are still being made in London, right? And they want the Federal Reserve, not just to exist, but they also have demands to do specific things to support the market in international credit, right? So they have a vision of what will ultimately come to pass, especially after 1945, that the US will succeed England as the most important country in the capitalist world economy, and they know that you kind of need a central bank if you're going to do that. And so from these different angles, farmers and capitalists both want a central bank, and neither one of them can get exactly the central bank they would have designed if they could just design it in a vacuum. They end up with a kind of compromise, right? The language in the Federal Reserve Act says that the purpose of the central bank is to furnish an elastic currency, right? We don't want the amount of currency to be fixed. We want it to adjust because sometimes the economy needs more. And in that moment, we don't want to be dependent on these sort of uncoordinated, anarchic private decisions, which even JP Morgan had found were unsatisfactory, right? So everyone can agree on a bill which will enable the central bank to provide an elastic currency. But there continue to be these points of conflict. What kind of elasticity and for who? Who decides, right? Who gets credit in an emergency? Who gets relief from the burden of having to immediately pay your debts, right? If you have to settle in cash at the end of a day, that's really constraining. If someone says, I'll give you a 10-year loan, and in the meantime, you do what you want, that's a kind of it's almost like a commutation of a death sentence, right? That enables you to continue to survive on easier terms. And so the question of who gets that and under what circumstances and who decides continues to be divisive, even though there's this broad consensus in the name of an elastic currency. And behind these questions about central banking are these sort of more fundamental conflicts about the extent of political control over the economy, right? Wall Street their ideal would have been just the kind of system that JP Morgan already had, but backed by the government power to create money. That would have been their system if they could have just designed the one they wanted. They think that you should draw the line there and not, extend it any further. But the farmers, had a different idea. They thought maybe we should have a central bank that does things that don't already get done in our system. Maybe we could use this to sort of change the distribution of power. And beyond that is a vision of sort of what kind of economic development should the state facilitate. It was not a debate about whether the state should facilitate economic development. No one in this debate with any power or significance thought that there shouldn't be a sort of state plan for economic development. It was really just a question of what kind it would be. And the regional system, what we talked about with the map, with the 2 places in Missouri and 1 out on the West Coast, that was actually one of the big concessions to farmers, right? Because even though, the whole West gets one bank, the fact that there are these banks, not just in the Northeast at all, was a concession to this demand from places like the South and the West, that credit should be somewhat more evenly distributed, right? So that's an example, although a fairly limited one, of this kind of democratic control being extended further than people on Wall Street would have liked it to be. So now in the next 2 slides, I'm going to try to cover the whole history since 1913, because I recognize that not everyone wants to talk about history all night. So I'm going to try to do it in 2 slides and really just make a couple of important points, right? The first one is that beginning almost immediately after 1913, almost as soon as the ink is dry on the original Federal Reserve Act, and very much continuing through to the present, the powers of the Fed have been transformed and expanded well beyond anything in the text of the Federal Reserve Act. And this has happened for all kinds of reasons, and it's often involved Fed independence from interest groups, right? So it's involved the Fed doing things that no group in society would have asked it to do exactly. And sometimes it's the result of direct pressure, and usually it's a kind of combination of those things. But the takeaway from this slide is that the Federal Reserve has just changed in a way that would be unrecognizable to people who wrote the Federal Reserve Act. And the first reason this starts happening is because 4 years after 1913, the US enters World War I, right? And so almost immediately, there's a lot more government spending, there's a lot more public debt being issued, and there's a political pressure from the state, the other parts of the state, on the Federal Reserve to support this program, right? So when the government, does spending, the central bank sort of has a choice about whether to accommodate that spending, right? By saying, yes, we will support the issuance of public debt. We'll make sure there's like a market for public debt at low interest rates. And that makes it easier for the state to deficit spend. Or they can decide to kind of obstruct it, right? They're going to say, we actually think this deficit spending is irresponsible. We're going to use our room for maneuver to make that harder to do, right? We're going to try to put pressure on the other parts of the state not to do that. And that second thing, right, the obstructionist path is hardest for the Fed to do during wartime, right? Because then there's a sort of military situation where even if you have no interest in, central planning, there's a sort of strong argument from the rest of the state and the coercive part of the state that the Federal Reserve should not obstruct the war-making powers of the state. And war-making powers in a modern economy are always also fiscal powers, right? In order to fight a modern war with battleships at this point and, whatever drone bullshit we have today, you need to spend a lot. And so there's a direct relationship between war-making power and spending power, and that brings the Fed into the picture. So the Fed was actually not originally supposed to deal very heavily in public debt, in federal government securities. It was supposed to deal mostly in short-term commercial credit. But in 1917, again, barely after the ink is dry, they changed that. And if you were to look at a graph, the amount of transacting that the Federal Reserve was doing in public debt just explodes, right? And that, even though it's kind of an accident or a contingency of World War I, it doesn't go away, right? Even in the 20s, even after the government stopped spending very much money, they start trying to balance the budget again. It still is part of what the Federal Reserve does to kind of manage the market for public debt. And down to today, that remains a major thing that they do, right? When they're managing money markets, they're really doing it through the market for public debt. When they're doing, what's known as quantitative easing or open market activities, they're usually buying federal government securities, buying public debt instruments from private banks, right, in exchange for cash. And through that, affecting the amount of money that banks have and affecting the market for government securities. And that comes in as kind of an accident, but it sticks, right? Another place where they shift pretty quickly is on the provision of certain kinds of agricultural credit, right? And as I said before, farmers are kind of one of the major interest groups pushing for the creation of the central bank. And so in the 20s, when there's long before 1929, there are basically depressing conditions in the United States and across the world for farmers, right? Farmers have a really bad time basically for the whole decade. And as a result, there's an extension of some of the Federal Reserve support of the agricultural part of the economy, right? Another thing that has shifted over time is the balance of power between the part of the Federal Reserve System that's centered here in Washington, D.C., and the part that's centered in New York City, at the New York branch of the Fed, which is sort of, by tradition and down to this day, directly responsible both for managing the Fed's interface with the money market on Wall Street, right? Because they're down there on the financial district. And the New York Fed also handled international affairs, right? Because they were like in the center of American international finance. And so there's also been a kind of tug of war between DC and New York. In the 1920s, New York is very much in the saddle, right? And that makes sense with what we sort of, think about New York and the 20s, an era of kind of really untrammeled stock market chicanery, right? A time before any securities law, right? There's no SEC. And so the New York Fed was quite in the saddle then. In the Depression, the balance shifts in the opposite direction. And there's a guy called Mariner Eccles who gives his name to the major Fed building here in DC, the Eccles building. Maybe some of you have been there or seen it. Eccles comes from Utah, right? He's a Utah banker. And so he kind of stands in for these regions of the country that feel like they're the outsiders to the elite centered in New York. They're still bankers, they're still capitalists, but they have a kind of different view. And so Eccles, along with people like Joseph Kennedy or Amadeo Giannini of Bank of America, who you can read about in Malcolm Harris's book, they form a sort of block of Southern and Western bankers who make an alliance with the Roosevelt administration and the New Deal state to try to pull some power back from New York to DC. And they pass a series of acts, most importantly, the Banking Act of 1935, which really fundamentally reorganizes the Fed, right? So something as basic as like the Federal Open Market Committee, which is the part of the Fed that is specifically in charge of making decisions about monetary policy, that is created as a result of these reforms in the 30s. So something as basic as that didn't exist, for the first several decades of the Fed's existence. It's a result of this struggle in the 30s. And of course, What comes after the Depression is World War II, and everything I talked about happening during World War I happens again during World War II, but on a much, much more massive scale, right? So the amount of government debt is just massive because half of the economy is now wartime mobilization, and that's being paid for largely through public debt. And at the same time, there's very little going on in the private economy, right? There's not a lot of private credit activity in the 30s, and especially during World War II. And so by the time the post-World War II period rolls around, the Fed has been transformed in a lot of ways, the most important one being how deeply involved they are in the management of the market for government securities, for public debt, right? Another big thing that changes is the expansion of emergency lending powers. And I talked about this earlier under the sort of colloquial heading of bailouts. And that's also something that has changed a lot. There's actually not a huge amount about it in the original act. One big shift that happens is in the 1930s when they make this amendment called Section 13.3. And I won't expect you to remember any other sections of the Federal Reserve Act, but if you know one, this is kind of the one to know, because it creates extremely elastic powers, enabling the Federal Reserve to lend directly to a wide range of institutions, including non-financial corporations, right? So they, theoretically under this act, until it's amended in 2008, the Federal Reserve can extend a direct loan to an individual non-financial corporation. They could say, Chrysler, we want to give you a loan. And all that's required for that to happen is for some majority of the Federal Reserve Board to vote that there are unusual and exigent circumstances going on. So 13.3 is kind of like a huge expansion of Fed powers. It's been changed over the years, but it's the foundation for a lot of the most dramatic things they did in 2008 and even in 2020. Then between 1970, if you guys have any familiarity with the kind of broad history of neoliberalism and capitalism since the 1970s, there's a lot of financial turbulence that starts in the 1970s, and as a result, the Fed begins almost immediately to expand its rescue efforts, right? Its bailout efforts, and you start to hear phrases like "too big to fail," right? That's already a phrase in the 70s based on the interventions of the Fed to rescue not just individual institutions, although they have that power, but to rescue entire markets, right? So let's say, technically, we really only care about the commercial banking system, but we realize that Chrysler's, the division of Chrysler that makes auto loans is really having trouble rolling over its short-term debt. And we worry that that will bring down the whole market for short-term corporate debt. And so we're going to do just whatever it takes to make sure that that market doesn't seize up and bring down the rest of the economy with it. That's something they start doing as early as 1970. I think that's something that's not always realized. I think a lot of people think that this happened more recently. People know about it in the 80s a little bit. They certainly know about 2008, but it really goes all the way back to 1970. Which is when they kind of rediscover 13.3 for the first time since the 1930s. In 2008, in the aftermath of that, they pass a fairly major, by US standards, set of financial reforms that go under the name Dodd-Frank. And Dodd-Frank limited 13.3 in certain ways. One big one was that the Fed no longer had the power to make these loans just to individual institutions, right? Because a lot of people were really angry about just the specific terms of the bailouts extended to places like AIG, or Goldman Sachs, or basically every bank except the one that they let fail, Lehman Brothers. And so now, as a result, when the Fed did stuff in 2020, they have to create institutions that are, in theory, broadly accessible, right? So you could want to save Goldman Sachs, but you would have to call it the investment bank special credit facility and say that technically anyone who meets certain criteria can come and get the money there, right? So that's one thing that changed. But besides that, these powers are still quite expansive. And not only they're expansive, they're kind of, even the laws aren't really often that constraining. And you see that in this quote that Powell made to describe the Fed's actions in March 2020, where he says, "We crossed a lot of red lines that had not been crossed before." Even the laws can often be reinterpreted by the legal department, right? They can sort of do something first and ask for permission later from Congress. And so even the laws aren't a tight constraint on what they do. The second point I want to make, right? So the first point in the political history was that there've been a lot of changes, and that the people who wrote the Federal Reserve Act would not recognize the Federal Reserve in any ways today. This is kind of the dialectical counterpoint to that, which is that throughout that whole history and throughout all the changes, the class character of the Fed has remained remarkably consistent. And the way I thought I would talk about that with this somewhat overcrowded slide that will hopefully make more sense is really to talk about the two most famous and mythologized people who've run the Federal Reserve, Arthur Burns and Paul Volcker. And the image here is just a Google search for Burns or Volcker, and you'll see that there's a kind of cottage industry asking, is Powell Burns or Volcker? It's a kind of like, I don't know, vanilla or chocolate, except no one likes Burns, so it's it's more like garbage or chocolate. But people have this idea that you can look at every Fed chairman and say he's either Burns or Volcker. And what do they mean by that? They have a kind of simple morality play in mind, where Burns was really bad. Burns was in charge from 1970 to 1978, right? So he was there during the great inflation of the 70s, which is kind of the big nightmare that still haunts people at the Federal Reserve today. Powell has this story that I kind of think is probably made up, but maybe not. But he uses it constantly. He's talking to a millennial or Zoomer who's working as maybe a security guard or a custodian at the Fed. And he's showing him around and starts to point at a picture of Burns on the wall and tell the kid about it. But even the kid already knows. He says, "Oh, Arthur Burns, he's the one who let inflation get out of control," right? And so that's Powell's way of saying everyone knows Burns did it wrong, and that's why Powell has to be very careful not to let inflation get out of control. Volcker is the opposite guy, right? Volcker comes in right afterwards in 1979, and he's in there through 1987. So Volcker is the guy who conquers the great inflation, and he's every central banker's hero because he had the sort of the nerve, the courage, right, to stand alone and do this unpopular thing that for some reason people don't like, which is to throw 6 million people out of work or whatever so that you can bring down inflation. And everyone hated it for some reason, but Volcker was brave enough to do it, to do what Burns had been too weak to do. So that's the sort of way that this is talked about and mythologized. And I think it's wrong on a number of points, and not all of which I'll talk about. But I think it's wrong in a way that specifically illuminates what I'm saying about the class character of the Fed, right? So I picked these two Fed chairs who are, in popular imagination, believed to be the most different as any two Fed chairs have ever been. But on these basic questions about sort of capitalism, they're on the same page, right? So when it comes to what is the sort of system that we live under and that they either are required to or want to sustain and reproduce, right? They're clear that it's a profit-motivated economy in which anything that happens or doesn't happen depends on profit opportunities. That's Burns. And Burns is saying that in a speech called The Need for Better Profits, right? He's saying that we need to improve profitability because if we don't, businesses won't invest and then we'll have a depression, right? And so Burns is really, he doesn't really see it as a hostage situation because he likes the people holding the gun, but he's describing it as the structure of a hostage situation, right? And this, this is basically what any Marxist state theorist would say too, right? We have a profit-motivated economy in which, to a large extent, what happens depends on private decisions, and those private decisions depend on the perception of profit opportunities. And so, as a result, a government institution like the Fed, no matter what people there kind of would like to do, is in some sense constrained to do this. As it happens, they also like to do this, right? And the Volcker quote kind of makes that more clear. He said that reliance on a market system with private property is just fundamental to the way our system works, to all the good things that have ever happened. You couldn't change it. And this is, some people might look at this and say, of course, are you surprised that he supports capitalism? And no, I'm not surprised, but I think, some people have the idea that Marxists and socialists are kind of reductionist when they say something like the Fed has a class character, and that class character is that the Fed is part of capitalist, the capitalist state. And, you can decide that's obvious or trivial, but it's true. And it's, it's true whether you're talking about Burns or Volcker or anyone else who's ever been at the head of the Federal Reserve. They also have thoughts about workers, right? Everyone kind of knows that Volcker was anti-worker because to crush inflation, what he did was crush labor. He sort of famously said this thing I have here, which is that the most important single thing that the Reagan administration did to help him crush inflation was to break the PACCO strike, right? The air traffic controller strike, where the leaders of PACCO were brought away in chains because it was an illegal strike, and all the striking workers were permanently fired and blacklisted from future government employment. That act of raw coercive state powers, what Volcker said was the most important single action that the Reagan administration took to help the anti-inflation fight. And what did he like about that action? He liked specifically that it helped to break the morale of labor, right? He said it was great when the Chrysler bailout in 1980 broke wage push in the auto industry. That was awesome. I loved it. In fact, I was part of it. I was there. But what did even more to break the morale of the labor was the Reagan intervention against the PACCO strike. So that's Volcker, and that's well known. But I think what's less well known is that Burns, the guy who everyone thinks is sort of soft on inflation, they think he was worried about all these, weird democratic pressures not to let unemployment get too high. Burns hated striking workers just as much. And we see this with, there was a wildcat postal worker strike by postal workers in May 1970. It was wildcat because they didn't have a union yet. Just like the PACCO strike, it was technically illegal, but it couldn't be crushed at that point because Nixon, had just invaded Cambodia, and if he had sent in the military to break up postal strike, there really might have been, a situation of ungovernability in the country. Not only were the college campuses in uproar over Cambodia, there was also wild stuff happening all over the labor front. Anyway, Burns hated striking workers too. He said that the postal worker strike was an insurrection against the government that was setting a bad example. So they're on the same page on workers too. And then this last part is about the bailout imperative that I've talked about a little bit under the heading of emergency powers. And basically the takeaway from these quotes is that Burns and Volcker both say they'll do whatever it takes to prevent a financial crisis. And again, you could say this is obvious. You could say that it's a good thing. It's better than letting there be a financial crisis. But the point is just that these two guys who are supposed to be so different basically say, we're not going to let the economy get destroyed if we have the alternative of bailing someone out and preventing it. So now I want to shift away from history. Thanks to everyone for indulging that historical thing. I do think it's clarifying, but to talk about the current moment, and I'm going to talk about labor, and then I'm going to talk about the climate, because I think those are two places where we can see most clearly how Fed policy might interact with political strategy, right? So what's next for labor? Hopefully everyone knows what is going to happen on July 31st, right? There's a contract expiring at UPS with the Teamsters, and there's a possibility there'll be like one of the largest strikes in a long time in the country. And it just so happens that there was also a really big UPS strike in the late 90s, right? And so since after a delay, we get to know what the Fed says at their private meetings, we actually know now what the Fed thought about the last UPS strike, which at the time was, the biggest strike, and for years afterwards was the biggest private sector strike. They were really upset about it. They really, really, despite how weak labor obviously was in 1997, they still kind of worried that this could be the sign of something else. And this quote here at the bottom from Greenspan is especially kind of telling, right? So I just talked about PATCO as, the most effective thing that Reagan did against labor and against inflation and to help Paul Volcker. Greenspan here says it's conceivable that the UPS strike could be PATCO in reverse, right? That it signaled a significant change in the wrong direction, right? Because they really don't want that to happen again. So we know for a fact that the Fed was following very closely the last Teamster strike against UPS in 1997, and they weren't happy about it. So I think we can say, without too much risk of being wrong, that the Fed will also be watching whatever happens with, this next one very closely. And the success of strikes in the future will depend on the tightness of the labor market, right? And the tightness of the labor market will depend in large part on what the Fed decides to do and how high they're willing to push unemployment. And so that's, hopefully fairly intuitive. We can talk about it in the question and answer, but this is just a flag that even after the Volcker shock, even after PATCO in the late 90s, they were still watching strikes really carefully. And they're going to be doing it now when there's, hopefully maybe a sign that some things might be changing. The next big question I wanted to talk about was, sorry, this is stuff I talked about. I think I covered these points, that the Fed is monitoring wage growth and unions. So both what happens in strikes like the UPS strike will influence what the Fed does, but also what the Fed does will influence strikes and labor struggles, right? So there'll be a mutual interaction there. And I put something to make it a little concrete. What does it mean, when the Fed tightens policy? Like, what could it do to the situation that workers find themselves in? What could it do to their willingness to do something like go out on strike? And so a 1% increase in unemployment would mean about 1.6 million more disemployed workers. So you see people talking, people like Jason Furman or Larry Summers, right? Kind of Clinton, Obama, Democrat economists. They talk about increasing the unemployment rate into the sixes, right? Something over 6%. And so there we could be talking about, 4 or 5 million more people being unemployed. So it's not a small number that they're talking about. And I think talking about it, the percent increase in some ways is mystifying. I think we should be more open to talk about it as millions of people who lose their job, right? Because everyone understands that. And maybe 1% sounds like not that bad, but it's bad. And even worse, the impacts are differential, right? So African-American unemployment is currently over 5%, and that's near an all-time low, right? African-American unemployment is always higher than the rate in general. 5% now is an all-time low. From 2008 into 2015, African-American unemployment never went below 10%, right? So that's how long that kind of double-digit unemployment can last for some parts of the population. And so that's also something to keep in mind, is that the impact is not shared evenly. Then there's the other little matter of what happens to our planet, right? And this is something where I think we can also really see crystallized what the politics of central banking mean, and maybe some sense of how socialists should begin to think about it. And I open here with a quote from one of the most kind of well-known and I think insightful people to write about the financial system and about central banking, Perry Merling. And he says that the normative or aspirational, I would just say, political aspect of monetary policy, monetary reform, is this question: how can we get elasticity for the projects we favor and discipline the projects we oppose? And that gets back to what I was saying about the question about how much money and credit in the economy is not just a quantitative question, more or less. It's a question of liquidity for who, right? Who gets that kind of commuted death sentence where you don't have to pay your debts tomorrow, but you can pay them in 10 years or never, right? Who gets that benefit of the doubt? Who gets that support that will ride them out through bad times, and who doesn't? And so it's kind of obvious that you might think, if you have an interest in the future of the planet, that we should have elasticity for decarbonization, right? It seems obvious that if we want to, tilt the scales at all in terms of what kind of investment qualitatively happens, it should be in the direction of decarbonization. But the Fed themselves are generally quite resistant to this. And I have here a quote from Randall Quarles, who's interesting. He was the Fed chair until 2021. He was very close to Powell, right? They were old colleagues from their private equity days. And Quarles was also specifically responsible for a lot of the failures of supervision and regulation that led to the Silicon Valley Bank disaster. So this guy is not just a very powerful guy, but a kind of guy with, like metaphorical and literal blood on his hands. And on his way out, he kind of asked this snotty question. He said, we're doing too much. And the problem with doing too much is it will invite questions we don't want. What are the questions he doesn't want? He does not want people to begin to ask why the Fed can't fund repairs of aging infrastructure, building of a border wall, purchasing trillions of dollars of green energy bonds, or underwriting the colonization of Mars, right? And I think this quote, I wanted to include it for two reasons. One is that even he, who is really upset about this prospect, thinks it's inevitable that the things that the Fed did in 2008 and 2020 will lead people to begin asking other questions, right? Why can't those same kind of extraordinary powers be used for other purposes, other more political purposes, right? Other more contentious purposes. Even he doesn't want it to happen, but he thinks it's inevitable it will. So I think we can say, that it will happen, and these are questions we should begin to ask. It also shows you that he views green energy bonds as, as serious as the colonization of Mars, right? Which tells you a lot about ruling class thinking. That I think they really think about escape to space as about as realistic as, a serious, adequate green transition. And maybe that's because they think that colonization of Mars is like way more likely, and that would be the nice version of it, or they think both are unlikely. But either way, they think of those as being sort of in the same universe of seriousness. So it tells you something about how the people who run the Federal Reserve think about the climate, which is not great, right? We can say that. And you might say, well, what if we appoint different people? That's interesting because Joe Biden tried to do that. He tried to nominate a woman named Sarah Bloom Raskin to a vacancy on the board of Fed governors in 2022. And this was rejected by senators, including Democrats like Joe Manchin, because things she had said led them to believe that the Fed might discourage banks from lending money to fossil fuel companies, right? And that would technically actually be sort of within the remit of things that the Fed has done. The Fed has often said that, our job is to encourage banks to do certain things and not do other things, right? They could say we don't want them to invest as much in subprime mortgages. But the idea that this might lead them to cut off money to fossil fuel companies led to the failure of this nomination, right? Democrats in the Senate decided that Biden's nominee was too hostile to fossil fuel companies. And even when she tried to say, no, I didn't mean it. I believe it's up to banks to decide which loans to make, not the Federal Reserve. It wasn't enough, right? So we have a kind of test case of what would happen if you try to just, appoint a good green liberal to the board, which is they wouldn't make it on, even if the Democrats controlled both houses of Congress. So those are my main points. I want to just kind of leave us with a set of tactical and strategic questions that socialists and allies of socialism might ask, right? I think it's worth trying to be as clear as we can about what kind of interventions we can hope to make and should we try to make, right? When we talk about the Federal Reserve, which I think we should be clear. Are we trying to just understand what's going on, understand how the system works, and predict what will happen? Because that's important for our other campaigns, like labor organizing. Or are we actually trying to influence what happens? If we're trying to influence what happens, what do we think gives us the power to influence that? If we don't currently have that power, what would it take to actually be able to influence decisions, right? So we should be always asking those questions instead of just asking, well, if we were theoretically running things, what would we do, right? We should sort of be asking what kind of intervention are we making when we talk about the Fed? To what extent are any of the different choices currently open to the Fed better or worse from a socialist perspective, right? I have views on this. I think more dovish policy is better than tighter policy, but it's also clear that dovish policy, which is to say, more money and credit rather than less, it doesn't even come close to solving the problems that we need to solve. And so there's an open question of to what extent any kind of monetary policy, even the best monetary policy, can solve the problems that we need to solve. I think we'll probably all agree that we need to talk about things like inflation, the cost of living, unemployment, the financial system, but we have a choice about how much we talk about the Fed when we do that, right? So that's another thing that I think is on the table. And then finally, there's this is a more either or choice. Should we talk about the Fed as if we want to change what it does, right? Should we say we want the Fed to buy green bonds, which would be a way of sort of expanding what the Fed does? Or should we talk as if we want to remove powers from the Fed? Say that we actually want public investment in green energy, but we don't want that to run through the Fed's bond buying. We want it to run through some more direct route, right? And so that's a kind of a question I think is useful because it has a sort of yes or no or A or B answer. And so that's what I have to say. I'm really, again, grateful to everyone for coming and listening to this. It's amazing, and I hope we can have a really good conversation now.
All right, so the start of the Q&A portion is going to be from our strategic campaigns. And I know there are folks from some of them here. And so I'm going to turn first to WePower and then give Defund and PD Chair the floor after that. And I think I'll speak for one or two of our campaigns if they don't have folks here. But I'll let Advait get a mic on and we can just hold.
Yeah, I guess I'll just do this. Hopefully folks can hear me. Hi, all. Great.
No amplification.
Gotcha. I'm Advait, and I'm one of the political education co-coordinators of WePower DC. And I guess the goal of our priority campaign within Metro DC DSA is to municipalize PEPCO, our private electricity utility. And we're also working on Washington Gas right now. Hopefully we can do something with them as well. And I guess that's where I'm approaching my initial question to you, Tim. Thanks so much for talking about the implication of the Fed on climate policy and how weird that gets. And I guess you touched on this kind of slightly, but I guess one of the main ways to look at the green transition, not just for the city, but for the world, is that it doesn't just require massive investment into renewable energy and making that cheaper, but also a massive disinvestment out of brown assets, polluting assets, the pipes under our city right now. And I guess I'm curious about your take on how does the Fed's control over that, I guess, overarching price of credit in the economy affect the economics of, say, a city that wants to buy up and wind down potential stranded assets like fossil fuel infrastructure, gas pipelines, the kind of challenges that I guess every city around the country is going to face in the next 10 years. And thanks again.
Yeah, thanks for that great question. And, I think there's probably a lot that we could talk about with that, but I think the way I would start to think about those kind of questions is to go back to what I talked about as the Fed's throttle, right? So in some, reductionist, but not too reductionist sense, we can say that monetary policy is moving in one direction or another, or it's kind of trying to maintain. And it's either making the cost of money lower or more expensive, more dear. And as a general matter, when monetary policy is easier and interest rates are lower, I think all else equal, it's easier to fund what you're talking about is the half of the green transition, which is investment in new projects, right? And that's true whether you're talking about a kind of public-private partnership where a private investor of some kind will need to find it potentially profitable to take a contract from a municipality or a state. And there's been some actually good reporting on this and related questions in the American Prospect that's worth checking out. There was one I was thinking about Ithaca, New York's attempt to do some of this stuff. And in that article about Ithaca, the reporter made clear that even with the hikes that the Fed has done already, right, which have been rapid but not especially extreme by the standards like the Volcker shock, even that level of change in interest rates has made the kind of private financiers who were potentially involved in the Ithaca thing wonder whether it'll be profitable. So I think there's not a huge margin there, and so there's maybe like a real single switch on off for that. The way that would affect a more kind of robustly public option would be that the conditions for municipal borrowing become tighter as they get tighter in general. There's also potential for the Fed to use its power to support municipal borrowing in particular. right? There was a sort of somewhat successful call to do this actually during 2020 when the Fed was sort of going crazy buying and advertising their willingness to buy all kinds of corporate debt, right, on the secondary market. There was a campaign to say, why shouldn't they do that with municipal debt as well, to sort of relieve the possibility that cities would run out of money. And there was a sort of half-hearted attempt to do that I think doesn't really count as a failure. It shows that the Fed was not really set up to or especially interested in doing this. But theoretically, it is possible for the Fed to try to directly support municipal borrowing, even if it was trying to constrict other kinds of borrowing, right? So if we were doing the version of the thought experiment where we control the Fed, that might be how we try to help.
Hi, thank you. My name is Stella Lewis. I'm the co-chair for the Defund MPD campaign. I fielded this question to Professor Richard Wolff, who's a Marxist economist, and he answered it very well. It is essentially around the politics of austerity and how it contributes to over policing, going back to the 1970s and white flight. Numerous cities, including ones that I grew up in. By the 1980s, a lot of cities were left to decide what to do with whatever minimum budgets they had left, start to strip a lot of social services. People under those desperate conditions then resort to, whatever they can to survive, and then we throw more police at every problem. That's something we've been dealing with for decades now. So I actually pivoted this question. I fielded it earlier. I wasn't sure if you were able to answer it, but how does the Fed at all affect these kinds of decisions at that level?
Yeah, it's a great question with, I think, a couple aspects to it. I think the biggest thing that comes to mind, again, probably I come out from a historical lens, is that the Fed monetary policy, especially when it's moving in the direction of tightening money, right, like Volcker did in a big way in 1979, was a huge driver of the kind of real collapse in the quality of social life in large parts of the country, including lots of urban areas. And so Black unemployment in the early 80s, was really had already been in crisis levels and just went through the roof, right? Because remember, at the worst part of the Volcker shock around 1982, the unemployment rate for everyone was almost 10%, right? And so if we think that Black unemployment is always some multiple worse of that, you really had real crisis conditions in large parts of the country, not only in cities, right? It hurt a lot of people in rural areas too, but the sort of most concentrated social harm I think that the Volcker shock did was to people in cities who were also they were hurting both because they were thrown out of work and also because city finances, urban finances became much harder to manage in a condition of really high interest rates. When credit is scarce, it's hard for New York City to borrow, right? Because New York City had defaulted on its debt in 1975 or almost done so until they worked out a deal. So you say, well, I have a lot of money and I it's hard to get this money. I had to pay a high interest rate to borrow this money. Why would I, risk it on something like a city? Why would I risk it on Detroit? So there's sort of at least two punches coming in, one of unemployment directly, the other of it being much harder for cities. Even if you have, right, you could have a Black mayor and a Black city council, and they could even want to do the right thing in some cases, but they face these real constraints, right? It's kind of the opposite of the power the Fed has. The Fed has this power to make and spend as much money as they want without constraint, right? That's at one end of the hierarchy. At the other end of the hierarchy is a municipality, right? Like New York City doesn't even make its own budget, right? Its budget comes from Albany, right? And even Albany has to raise that money through taxes. So we have a system where at the top, at the federal level, there's a possibility for a kind of unlimited spending. There aren't budget constraints unless there are political reasons for it to be. At the local level, it's much tighter. And so I think a lot of the worst damage is done on the local level and in cities for that reason, that they sort of have the hardest time getting around these constraints. And so I think it's not an accident that the decade of the 80s and early 90s, which is the decade of the fallout from the Volcker shock, saw the rise of mass incarceration, right? You throw 1 in 4 people out of work in certain neighborhoods. What are you going to do to manage those people who aren't being disciplined by having a job, right? Which is the way that people are usually disciplined under capitalism when there's not a depression. Well, one way that that's managed is by locking them up, right? So I think that there's a direct connection in that way.
So two related, upside down, right side up now, good. Two related things that happened in the last today and last week in part of our chapter in Montgomery County. Last week, we opened the first publicly financed social housing project in the country. It's really awesome, mixed income, but it was bond funded. And the first bond was actually issued before the Fed started raising interest rates. So they got an incredible rate. And now the cost of building that infrastructure is going up every time the Fed increases its rates. So it's actually curtailing the public sector's ability to find solutions to our problems. And then today we had a hearing on rent control, which we're also very excited about. Things are looking good, but they also discussed how during the Volcker shock, rent controls were actually modified, not legislatively, but technocratically around the idea of a fair return. And that's based on the interest rates that they're getting in other parts of the market.
Right.
So when interest rates go up, it means that renters and rent controlled systems are going to pay more as well. So capital extracts more out of us.
Right.
But I guess those are two exciting things that are happening. But can you talk a little more about how the housing market and how tenants and homeowners are impacted, by the Fed, and how we should politicize that?
Totally. That's fascinating to hear about. And it's just, it's great that the public development things happening. And it's just generally great that, I don't know, everyone's learning about bond finance. And, I think the first thing I want to say about is this is just a sort of more concrete example of what I said in response to Advait's question about the public power campaign, right? Which is that a general tightening of financial conditions makes it harder to do this kind of county or municipal stuff. So what is bond finance essentially? It's essentially a kind of longer term borrowing, right? That can be done publicly or privately, right? In this case, we're talking about doing it publicly. And so it just becomes harder for Montgomery County or another county that wants something similar to borrow, the higher interest rates go. I also really like what you said about the sort of political way that the Volcker shock filtered into rent control, right? It's a great, I think, crisp example of how, these decisions, which on some level are as simple as like moving a throttle, they then filter into like every part of life and politics and in 1,000 different ways, but they touch everyone. And what I thought was especially interesting about that story you shared was it sort of shows, it's an example of how our economy is organized in a way that people with more power are able to usually pass on the cost of whatever bad thing happens. So in this case, interest rates went up, right? And that imposes certain costs on landlords. But then the landlords were able, right, to use their power to really pass that cost on, right, to get compensated for what interest rates were doing to them by increasing rents. And the reason I think that's significant is it's a corrective, I think, against a tendency some people on the left, hopefully no one in this room has, that there's something good about higher interest rates because it can sort of punish capitalists too. And it's not factually wrong, right? When interest rates go up, businesses fail, right? Like banks also are borrowers, like a lot of the time, in addition to being lenders. So it's not false that higher interest rates can hurt capitalists too, right? They do. And it's not even necessarily false that higher interest rates might remove some of the like most annoying things that they do, right? Like, a lot of sort of really dumb startup stuff, right? Stuff that could clearly not really make a profit if interest rates weren't zero, right? A lot of this stuff really sucks and it's annoying and like we hate it and we like to see them burn. Or like crypto is another great example, right? To the extent that Powell has helped to like puncture crypto, people think that's great. And that's all true. But I think in general, people with power have a way of protecting themselves so that the real harm of the higher interest rates gets passed on in one way or another. And so I thank you for that. It's, I think, a crisp example of how, you might think this hurts landlords too. Maybe it'll discourage speculation. It'll bring rents down somehow. But really, they usually have a way of being okay no matter what's happening, right? And the people who aren't okay are the people without, the power to pass the cost on to someone else, right? Can you kick it down to someone else? At the bottom of that pyramid, those are the people I think who are hurt most by a hawkish turn in monetary policy.
All right, I'm going to speak out on behalf of our labor campaign. And so one of the best parts about being in Metro DC DSA is that we both organize and support labor campaigns around DC and including the National Teamsters campaign that Tim mentioned earlier. And I think one thing I want to ask is about whether some of the bare knuckle tactics that we've seen. I think I want to cite one local example, which is Moon Rabbit, was a restaurant that was unionizing, was part of a hotel unionizing campaign. And the hotel that fed the union drive closed down a restaurant that had just received many awards in order to fight the union campaign. Didn't work, which is great. But you're seeing very bare knuckle tactics in that, in the National Starbucks campaign, including some local firings. I was going to ask whether you see higher interest rates and changing corporate environment through Federal Reserve policy. Is that influencing any of the more aggressive labor tactics that we've seen in the last year or two?
Yeah, it's a really interesting question, and again, I think there are a couple ways to come at it. first, I was struck that the example you pointed to was a hotel, right? Because in a lot of ways, I think the leisure and hospitality sector, right, which is the way it's referred to in the government statistics, but restaurants, hotels, is in some ways been the ground zero of a lot of the sort of most intense distributional conflict of the recent inflation, right? Because I think these are workers who were extremely underpaid and exploited, and also just qualitatively often very badly treated before, right? Anyone who's worked a job like this will have stories about that. And these are people who in the long, sort of slow, weak recovery after 2008 did not have a lot of bargaining power, right? Because unemployment was high. And so I think you had a situation where, there were workers who were sort of really were, overdue for higher wages, for quitting a bad job, right? For telling the manager to go to hell. And they were able to do that, a lot of them, in 2020 and afterwards, as a result of a lot of things like the expanded unemployment insurance, and then as a result of what happened after the reopening, which was a sort of enhanced demand for things like going to hotels and eating out. And so as a result, we saw that quit rates, right, which are a good measure of the power workers have, right, is how easy is it to quit your job if you don't like it and find a better one. Quit rates were high throughout the economy, but they were at highest in sectors like hospitality and leisure. We also know that the Federal Reserve, Jerome Powell talks constantly about this inflation in the service sector, right? And there are some sort of structural reasons for that, because these are labor-intensive services, right? Like the cost of running a bar, paying the bartenders is a big percentage of that total cost compared to running a chemical plant where you have a lot of machinery and capital and stuff too. So there are places where the cost of labor will actually make a big difference to the bottom line. So the first thing I'd say is that, a big part of what's driving, I think, the Fed's turn to be more hawkish is concern about the amount of power and the things like quit rates in these sectors like hotels. Then to kind of come at it from the other aspect, which is really more the question you asked directly, how is what the Fed is doing affecting corporate attitudes and corporate orientations, right? I think at the very least, you can say that, again, getting back to the question of what happens when the throttle moves, right? When the Fed tightens, when financing conditions become tighter for businesses, households, everyone, every business is going to start to look more carefully at their costs, right? They're going to, their constraints are going to start to bind more tightly. If they need to borrow money, they're going to be paying more for it. And so when they want to cut down on costs, especially in a sector like hotels, but really everywhere, we know that one of the first places they'll try to do this is hitting labor costs, right? Both because it's a large percentage of their total costs in many cases, but also just because it's part of our culture that it's okay to take the stuff out on workers, right? And there's even some segment of people who will think that, if people have to work a little harder because they're more scared of losing their job, that's a good thing, right? You could find someone willing to say that in public very easily. So I think certainly the tightening conditions will lead employers to take a harder stance. I think what we haven't seen yet, and I'm not sure if we will, is what we saw in the Volcker moment, when there was a kind of more explicit alliance between corporate campaigns to crush unions, which were of course much larger and more powerful at that time, and the Federal Reserve campaign to crush unions. That rose to the level of a kind of conscious class collaboration. I suspect that now it's working mostly through these indirect measures, but we'll see, what happens.
Thank you. So want to wrap up toward 8 o'clock, which means I think we have time for a few questions.
And I'll just say that I have my email on here too, and I really, if you have anything else, please do email me and I'll try to get back to you.
And also want to encourage everyone to head happy hour afterward, Mark's Cafe, and we'll cover briefly, but let's have time for at least one question in here. You can raise your hand if you want to ask. I see two. Yeah, let's go with
My person who wants to. This is a bit of a leading question, but I just want to bring the internationalist element into this. Could you speak a little bit about how Fed policy affects the global South, particularly when there are long periods of loose monetary policy followed by contraction, as we saw in sort of with the Volcker shock and arguably today?
Yeah, absolutely. And thanks for the reminder that it's an important thing to talk about. I mentioned at the beginning that the Fed has an influence on the world, but I didn't talk about the rest of it, which is an oversight. And luckily, Volcker, who I've already talked about a little, illustrates, I think the general nature of this relationship pretty clearly. What does it mean for the rest of the world when the Federal Reserve changes policy? It does the same thing it does for people within the United States, households and businesses within the United States, which is it changes generally how easy it is to get a loan, right? But it does something actually even more important, which is it affects the status of the dollar, right? And the status of the dollar has a special meaning for people in other parts of the world because no other country in the world is able to limitlessly create dollars the way that the US Federal Reserve is able to do. Why does that matter? Let's take an example. During the 1970s, when monetary policy was not necessarily loose, but not as stringent as it became under Volcker, there was a huge boom in US commercial banks lending to countries in the global South, right? And they were also, in this case, recycling was the term for it, petrodollars, right? So what was happening was oil-producing countries in the global South had huge amounts of money, liquidity, but they didn't really have a developed enough or deep enough financial system at home to take care of it. So the US commercial banks took that money, took a fee for managing it, and then lent it out to other countries in the global South, right? Largely in Latin America, but lots of other places. They did this on the assumption, and this is a real quote from the head of Citibank, Walter Wriston, that countries don't go bankrupt. So they thought it doesn't really matter how much money we lend out, like they're good for it, right? But this money was borrowed in dollars, right? If Citibank lends money to Mexico, the loan is in dollars. It has to be paid back in dollars, right? That's what it means to borrow in dollars. You can't pay it back in pesos. You can buy dollars with your pesos, but then the amount of pesos you're going to need to buy $1 can change, right? So what happens with the Volcker shock? One thing, there's like a worldwide depression. And so what does that do to the price of commodities, right? Say you're a country in Latin America and you mostly export raw commodities. The price of those commodities goes down, right? So you're now getting less money for the things you export. That's bad, right? But what does it do to the dollar and the cost of paying back a debt contracted in dollars? The dollar becomes much stronger, right? Because interest rates in the US are going up, money's coming into the US, that's pushing up the price of the dollar. And so the counterpart of the Volcker shock is a huge strengthening of the dollar. So it suddenly becomes much more expensive to pay back debt that you contracted in dollars. So all of a sudden, a country like Mexico or Brazil has lost half their export earnings, right, because of what's happening to prices. At the same time, the cost of repaying their dollar loan is going up. So they're caught in a really impossible scissor situation where they're essentially forced in order to avoid default, to go on their knees to the US Treasury Department, the IMF, the World Bank, in order to say, please stop us from, complete financial crisis. And the global North said, yes, we'll do that. We'll do that mostly because also our commercial banks would fail if you guys defaulted, right? The reason some people talk about, bailing out Mexico or something, which happened in the 80s and 90s, two different occasions. But I think the better way to think about it is bailing out Citibank, because Citibank would have gone under if Mexico had defaulted, right? Just as an uncontroversial statement. And so, the US is able to do this not out of its generosity, but because it's concern for its own financial institutions. And then in addition, they extract structural adjustment as a condition from a country like Mexico to say, we will, quote unquote, bail you out, but in return, you're gonna have to do all these things we want to do and essentially surrender a lot of national sovereignty over economic development. And so the Volcker shock was the death knell of a lot of sort of third world developmentalist import substitution programs. And was a lost decade for much of the third world, where growth and employment at best stagnated for almost 10 years. And so the Volcker shock is an extreme example of that. We have not so far seen anything on that scale yet, but in terms of understanding the basic forces at work, those are the dynamics, and they will be the same to the extent that interest rates rise as high and as quickly as they did under Volcker.
Thank you. I think we have time for one more question, and I hope we can continue the discussion after.
Yeah. Hey, Tim, thanks for coming. So I reckon it may have something in like wrapped up in the broader obfuscation of how we talk about the Fed, but and I heard it several times here, but we always hear that the Fed is closely watching or paying attention to various trends and phenomenon. It has such like an omniscient tone to it. So what do they actually mean when they say that? Are they just reading the Financial Times and then getting together on the weekend to talk about it? Or do they have access to something that we don't? Or
It's a great question. They have not responded to my FOIA request about crystal ball. They may or may not have. So the jury's out on that. But I like the question because the answer is kind of, they look at all kinds of things, right? But the answer reveals, I think, not just that they do have like a lot of sources of information, but also it reveals like some of their limitations or their kind of stupidity, I would say. Because what do they look at? They look at everything from economic statistics that they see a little bit earlier than other people, but not that much earlier. They also rely on a lot of meetings, right? And this is somewhere where the regional structure that we talked about becomes directly relevant. The directors of, say, the San Francisco Fed, right, will meet regularly with the directors of the San Francisco Fed, who are, mostly business leaders. Those business leaders will pass on complaints from other business people. So the regional Fed structure is a sort of funnel for largely anecdotal senses from business owners. And so I really encourage people to, if you go to the Fed website, you can read, they release the transcripts of the FOMC minutes with a delay. So you can go back and read them from, I think it's now up to like the end of 2015 or so. But you can see just like the way they talk about it. In a way, it's very casual. They'll say, I met with someone in our district and, he came from a large manufacturing company, and then that part will be redacted because like you're not allowed to know who that was, but you know it's a large manufacturing company. And they said they saw a lot of people with tattoos getting hired recently, and then I'm not kidding. They will seriously sit there and say, well, like, this is a point in favor of tightening the money supply because someone told us that people are hiring personal assistants with tattoos. This is in the late 90s. I'm sure it's easier to get a job with a tattoo now, but they thought this was the weirdest thing and they laughed about it, And it gets even worse than that. The head of the San Francisco Fed, Mary Daly, who is, in political terms, not the worst person on the Fed by a long stretch of the imagination, she will give a serious speech where she says, at the hair salon I go to, prices keep going up. And that's an example of how service prices are going up, because wages are out of control. And so I think this is part of the demystifying too, is like, on the one hand, they do have a research staff, like they are following things like, different price indexes, right, and weighted price indices. On the other hand, like they are really willing to take on board as serious evidence things like my haircut is getting more expensive. And so I think it tells you something about the class character and also the seriousness, right? They're not omniscient. Neither are they omnipotent, although they are much more powerful than anyone in this room or almost anyone else in the city. But they are often befuddled, right? Whether because of their class character or just because, as much as anyone else, they're confused by what's happening. They don't really have a theory of what inflation is or how it works. And in their more honest moments, they'll tell you that. So I think it's important to remember, like, that, they're watching things, they're trying their best. But, they're also listening to a bunch of car dealers tell them, like, what the vibes are, and it can be really demystifying to read some of these old transcripts because they're in a room hanging out, kind of having a bull session, like they're like you and I, but worse.
All right, we started a few minutes late. Let's do one last question from the back, and I think wrap up after that.
Hi, I'll keep it brief. Is this too close or cool? So you ended your part of the presentation with a long list of questions about essentially for us to ask in terms of how we want to engage with the Fed, what we want its role to be. And assuming that we do want to do something about it as socialists, assuming that we do want to exert some sort of power over the Fed, what are the real inroads to do that? So, for example, we have people in Congress, some people in Congress who call themselves socialists. But in terms of what you discussed with Biden's nominee for the Fed, it seemed like that was really, there were a lot of very significant stumbling blocks to that nomination. So yeah, what would those inroads be, and what's the most effective thing for us to do about it?
Yeah, thanks for that question and for the challenge to actually answer some of the questions I posed to you guys. I do genuinely want a lot of those to remain open questions, because I don't know the answers, and I think that we should decide on it, collectively looking at our experience. But I will say some more specific things. One thing that's clear, if you look at the history of the entire Federal Reserve, is they've very often, I think you could almost say usually, been under more pressure from other parts of the government than they currently are. We have a culture now of really kind of extreme, even by historical U.S. standards, deference to the Federal Reserve. But if you go back and look, I think this really, the extreme deference really dates actually to the Clinton administration. The Clinton Treasury Department made a decision that they were never going to publicly criticize the Fed. If you go back even one president before that, to George H.W. Bush, the H.W. Bush Treasury Department was constantly kind of calling out the Fed in public. And people would clutch their pearls and say, what about Fed independence? But someone as sort of boring, normie, as a picture of the establishment as George H.W. Bush, he had no problem saying his Treasury Secretary should go out there and criticize the Fed, right? And if you go back to the 70s, Congress considers hundreds of bills which would have limited the Fed's autonomy, including in some potentially radical way. They consider lots of laws that would have directed it to allocate credit to some places and not to others, which is a good analogy for the climate thing. They considered legislation that would have actually taken away its control over interest rates. And you can tell, again, from reading the historical evidence that this threat, even though none of those bills ever really got very far, they did feel kind of like against the ropes. And I think they need to feel that way again. And maybe Biden can't get Raskin on the actual board of Fed governors, but there are people in Congress now who could and should, I think, start showing a lot less deference. I think we've seen some movement to this. I think, Ayanna Pressley in particular has done some work in combination with movements like Fed Up, pushing the Fed on issues including Black unemployment, which I talked about. But I think we could just see a lot more of like, let's get back to like George H.W. Bush or maybe even Harry Truman levels of messing with the Fed's mind, right? Because those are like establishment-centric figures. And if we can't do that, like we're not in a good place.
All right, thank you. So before we leave, two things. First, happy hour, Mark's Cafe, and if it's too crowded, we'll move to Hades Mexican restaurant. But second is just chapter programming. We love talking things through. We love learning things. And I can give you a few pathways to do that, along with ways to join the organization and start organizing, because we don't get Harry Truman chewing out the Fed without a little pushing.
Or a lot.
Yeah, or more. And so a few things. There's summer reading groups. If you'd like to get together, there are 7 books and 7 different groups. You can choose by night of the week or the topic. There's Blackjack Men, Will This Radicalize You? Labor, Power, and Strategy, Red State Revolt, which is about education. Poor People's Campaign, which has a housing focus. And Marx at the Museum, we're doing cultural Marxism, y'all. So the 7 summer reading groups. And we're also doing the next event, the political education working group is putting on the Villains of Silicon Valley walking tour. You are free Saturday, July 1st. We'd love to see you. Featured Malcolm talking about his book Palo Alto and about how Herbert Hoover and a bunch of capitalists here have done bad things. It's in downtown DC, Freedom Plaza, 1 p.m. Saturday, July 1st. And in terms of this format, maybe even this room, I don't know, but this format, the next night school is Thursday, July 20th, talking about social housing. We'll talk a little bit about some issues that Frankie raised that we talked about today, about ways to build housing that is publicly financed and affordable. And if you want to get involved, the best way, if you're here, just talk to us. Raise your hand if you help set up and can talk about political ed. People are in the back, and talk to me. Would love to get you involved. The other way is show up for a meeting, the formal way. I think it's June 25th, 2 p.m. And we'll have another walking tour later on. The work continues. There will be more reading groups in the fall. There will be more night schools beyond the one that you see. We'd love to see you at those events. And again, the best way, if you are here, if you want to get involved, is to talk to folks. But if you're not subscribing to the Metro DC DSA newsletter, it's the best spot. And Stopout Slumlords has an email, tenants@mdcdsa.org, and online sign-up forms. And so, but please, would love your help putting away the chairs, getting the tables back, and heading out to the happy hour with y'all. Thanks so much, sir.